Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. A surging dollar bulldozes through Asian FX. The region's stocks also take a hit following a big tech sell-off on Wall Street. The Fed's Mary Daly says there is no rush to start cutting rates. China's first quarter GDP growth beats expectations, but retail sales and industrial output disappoint in March, suggesting a slowdown is already underway. Plus, Israeli military officials say they have no choice but to respond to Iran's missile and drone attack. This as the US House prepares to vote on new aid to Israel and Ukraine. Let's check in on these markets then. After a thumping for US stocks yesterday, a drop of around 1.2% for the S&P, the lowest level in about 2 months. You're crossing back below 5,100 for US stocks on stronger data out of the US. Retail sales data coming in stronger, building out those expectations, of course, that the Fed will remain higher for longer on interest rates. Then there's the geopolitical overlay as well. Currently looking at further downside flagged by US futures. S&P futures pointing low by 0.2%. Nasdaq futures looking to losses of around 33 points. Here in Europe, you are set, it seems, for a shellacking across the European markets. Futures pointing lower by 1.3%, a drop of 64 points. FTSE 100 also pointing lower by a similar margin, looking to losses of 1.28%, down 102 points is what's been flagged across these futures. Let's flip the board and look cross-asset then. The sell-off as well across treasuries yesterday was pronounced. The 2-year is getting close to 5%. The 10-year, you saw a 9 basis point move higher in yields. Currently, the 10-year benchmark at 460. The pound in focus today on the back of wage data that comes out at around 7 a.m. UK time. We have CPI out of the UK on Wednesday. 124 on the pound currently. It's more of a dollar story, though, right now, down 0.1%. The surging dollar, again, pressuring a number of currencies. Brent at $90 a barrel. We've seen a tick up again on the back of the geopolitical risks. The Israelis saying they will retaliate at a time of their choosing. Currently up 0.6%. And iron ore under pressure as well. You can tie that to the China story, down 1.2%. So we'll be looking at the miners as well, listed in the UK, 110 per ounce there, per tonne, I should say, on iron ore. Let's cross over to Asia and check in on how the Asian markets are faring. Cross over to Dubai, in fact, with Vonnie Quinn is standing by for a check on those Asian markets and the Middle East as well. Vonnie.
Well, you said it, Tom. These are markets beset by woes. It might be good for the US to get stronger data, but it's not so great for the rest of the world waiting on Fed interest rate cuts. We're seeing it particularly in the currency space and in fixed income, as you mentioned. Also, though, it has to be said, in equities, these are really markets falling out of bed across the board today. So you mentioned the yen, 154.27 is where we're at. Economists and analysts now looking at 160.2. So that was the 1990 level intervention as a potential point of intervention, but we may get something before that. On the other hand, as our MLive strategists have pointed out, it may not matter if the BOJ intervenes or if monetary officials intervene if the Fed can't cut yet. So there's a lot of question marks out there, and you're seeing it across the FX space in Asia today. The Korean won crossed the 1400 mark earlier. We're well below that again now, obviously, but still 0.9% weaker versus the US dollar. We do, by the way, have a BOJ meeting in 10 days. May not get an interest rate hike there, but it is something to watch for, at least hawkish rhetoric from the governor. The Nikkei 225 down 2.1%. The Kospi in Korea down 2.4%. It is really just across the board in Asia. I know you'll be speaking about China. Some better news among the data dump, not even helping in China. But let's flip up the boards and take a look at the Middle East as well, because geopolitical events and rhetoric obviously impacting these markets as well as we head through the week. The market was trading yesterday. Obviously, we've been closed for hours now and we haven't opened up for the Tuesday session, but the Tadawul reversed the previous day's declines, up about 0.33% at the end of the session in Saudi Arabia. In Qatar, we also saw a reversal with stocks of about 0.8%. In Israel, a reversal as well, lower. About midway through the session, when we got hawkish rhetoric out of Israel, stocks turned lower and the TA35 finished down 1.25%. One currency that is actually strengthening, though, is the shekel, and that's thanks to the weakness that we've had for several sessions now. Strengthening yesterday, strengthening once again today, but just by 0.1% right now. Tom.
Bonnie Quinn, thank you very much indeed, with the market share across Asia and the Middle East, joining us out of Dubai. A redhead crossing the terminal right now. We know, of course, it's a big week for earnings. Ericsson coming through with what looks like a sizable beat, at least in terms of first quarter adjusted earnings before interest and tax. You're coming through with Swedish krona of 4.31 billion. 4.31 billion Swedish krona. The estimates had been for a little over 2 billion, so almost double the estimates when it comes for adjusted first quarter earnings for Ericsson. The margin also, the gross margin also a beat for this company. The telecom equipment maker, of course, coming in at 42.7% for the gross margin adjusted for the first quarter. The estimates had been for just shy of 40%, so a beat on the margin as well. The expectations coming into these results had been that the weaker demand from mobile operators, of course, the customers for Ericsson, would weigh on profits. It seems like that has not come to pass, at least in the first quarter. We'll unpack that story in more detail for you and, of course, check in on that stock at the open at 8 a.m. UK time. Now to China, where the economy grew 5.3% in the year to the first quarter, beating expectations, but a tail-off in industrial production and retail sales in March suggests more support may be needed to sustain that momentum. Let's bring in then Bloomberg Asia economics correspondent Katya Dimitrieva. Katya, talk to us about the good news in these numbers then. Top line, growth beating in the first quarter.
Well, the good news is factories. So a lot of the growth in GDP in the first quarter was led by an increase in manufacturing and this sort of secondary sector. The Chinese industry is kind of divided into three different sectors, and it was the secondary one that really led growth. And that is all manufacturing and trade related, so exports growing. Aside from the industrial side, though, there's not much else good news in the data we saw today. While economists kind of raised their estimates, we saw DBS was the latest to kind of raise their estimates on the back of GDP growth. There's still a lot of concern about domestic consumption and being able to keep this same or similar economic growth throughout the year to kind of reach what the government wants, which is around 5%, as they say. In terms of the negative side of things, you just have to look at the top line figures. Retail sales were lower than expected. We saw home sales, home prices dipping down. Nothing in sight that is potentially going to change that dynamic. And without those two things, analysts warn that this is just simply not sustainable.
Look, you touched on the domestic consumption, the retail story then. Is there any sign that the consumer, the beleaguered consumer in China, and of course there are links there from the consumer, the health of the consumer to the real estate market, that those things, that assumption, that optimism is turning around?
There are some signs that later in the year things could improve, but there aren't a lot of details yet on it. And what I'm referring to there is the government's sort of cash for clunkers program. So what they're hoping is that consumers can bring in their old appliances and get them replaced with newer ones. Now that's going to be spurring industrial production a bit more, manufacturers a bit more, to sort of continue that trend that we've seen in the first quarter. And there are some economists who say that could add as much as 0.07 basis points to GDP throughout the year. The only issue with that is we don't have a lot of details on how that will work, how that will kind of be measured over time, how easy that'll be to bring in. There was a press conference this week that sort of delved into that just a bit more, but we're still unclear on how the details of that will be worked out. So there is one silver lining there. The other thing, just in terms of the property market, that's really going to be the big one. And in that regard, I think the government is expected to come in with some more fiscal monetary support here, because that's the big question mark this year.
OK, Bloomberg Asia economics correspondent Katya Dimitrieva with a great breakdown there of the China eco data and what to look for as well in the weeks and months ahead. Thank you very much indeed. Staying with China, German Chancellor Olaf Scholz has met with Chinese President Xi Jinping in Beijing. The visit comes as tensions, of course, between China and the West mount over trade issues and the conflict in Ukraine. For more, let's bring in Bloomberg's Oliver Crook, who's been following this for us, joining us from Berlin. Ollie, what can you tell us then about the conversation between Xi and Scholz? What do we know?
Yeah, Tom, setting this up, we really had three main topics that Scholz wanted to go there and speak to President Xi about. The first was the war in Ukraine. The second is all of these issues surrounding trade, which we know have sort of stolen the headlines, kind of really is the main issue for this visit. But then also sort of the green energy transition. And all of these things are sort of connected in a kind of interesting way. On the question of Ukraine, there isn't so much distance, I think, that Olaf Scholz could really hope to get from President Xi in terms of his stance there. He said he brought up a just peace with the president when they went into the meeting. We haven't had yet the fruits of the meeting, but that is going to be kind of one of the main topics. And the second, of course, is this question of trade, a trade question that is so important both to Germany and to China. And really, China, in a certain sense, really took Germany's space as the exporter to the world. In 2010, became the world's biggest exporter. That was really Germany's focus. And as you can see there, Scholz saying that basically both China and Germany are trading nations that benefit greatly from the World Trade Organizations, and they are committed to strengthening the rule-based system. We also got a comment from President Xi saying that as long as the principles of mutual respect, search for common ground, despite differences and mutual learning from each other, bilateral relations could continue in a stable and consistent way between Germany and China. And really, this is not really a big smiles and, warm welcome sort of visit, but it is one that is sort of one of mutual respect and understanding. And that's sort of the meeting between the two leaders, I should say. I should say, though, Tom, yesterday there was a moment of humor and when he was visiting Shanghai at the university, and obviously the news of legalization of cannabis made it from China to Germany, and he was asked by a student that if he came to study to Germany, would he have to consume cannabis? And Olaf Scholz said, no, don't worry about that, you don't have to. I'm turning 66 this year, and I have never done so.
Right, okay. Well, informed Chinese students on the topic of cannabis legalization in Germany. Look, trade, we're probably not going to get cannabis trade between Germany and China anytime soon. But trade broadly contentious, right? And the Europeans are basically kind of taking their gloves off, many would say finally, on this issue. They're stepping up probes on a number of issues. How is that tying in to the German Chancellor's visit?
Yeah, Tom, so obviously we have the EV sort of question, which is the biggest one here about whether or not the EU is going to slap tariffs on the Chinese EVs. And really, an economy that has, the Chinese economy has really set itself up to try to win during the energy transition, and I think that the Chinese would argue, listen, we have looked way ahead of time. We have a raw material policy that is decades ahead of European ones. We have, sort of access to the lithium and all of the other minerals required. And that is really why we're winning. The Europeans, on the other hand, are saying, no, this is down to unfair competition. There's a lot of subsidies, there's a lot of tax advantages, a lot of access to things that European companies don't have, and this is really at the heart of the issue. So you have it on EVs, you have it on solar and wind increasingly, and yesterday we had the scoop, Tom, that on medical device procurement. So this just gives you an idea that the EU is really looking at all parts of this, but I think what's interesting is that this will now invite a number of questions into Europe. The Inflation Reduction Act, one would say, is potentially got some of the same issues in terms of subsidies and tax cuts. Will the EU really undertake that, or is this really just a political question? There is also the question of Europe's own competitiveness, right? How can Europe be competitive? Because the Chinese would say, we've just outcompeted you, and that is going to be the focus of the EU leader meeting later happening this week in Brussels, where all the EU leaders are coalescing and coming together to try to talk about how do you get Europe to be more competitive.
OK, Ollie Crook in Berlin. Really fascinating. Thank you very much indeed with the deep dive on that visit, of course, by the German Chancellor and what it could mean more broadly for how the Europeans are thinking about trade with that crucial trading nation. Across what you need to be looking ahead to the rest of the day, 7 a.m. UK time, just flagging for you in terms of the data coming out of the UK. It's a big week, of course, in terms of inflation. That drops on Wednesday. But later today, 7 a.m. UK time, we're going to get wages out of the UK, plus unemployment data as well. Wages seen softening a little bit, which, of course, will be welcomed by the Bank of England. 7 p.m, meanwhile, UK time, Bloomberg will be speaking to the UK Chancellor Jeremy Hunt. Of course, a crucial election year as well, but his reaction to the data, maybe questions on the BOE, and, of course, likely political questions as well for the Chancellor. That's coming at 7 p.m. UK time. Speaking, of course, to Bloomberg. We're also going to be getting on the earnings front. We had Ericsson dropping at 7 a.m. UK time, 6 a.m. I should say. We are switching focus to the luxury space later today. We're going to get LVMH sales as well, so a key gauge there on the health of the luxury sector. And also today, following that strong earnings print that came through from Goldman Sachs, Bank of America and Morgan Stanley, their earnings drop as well. Can they follow suit from Goldman in terms of the pickup that they're seeing in terms of the trading parts of their businesses? The earnings story being fleshed fleshed out later today on the banking story. You can get a roundup, of course, of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go to get a deep dive there on what to look at. Coming up, Israel vows to respond to Iran's attack over the weekend as the West calls for restraint. We get the latest next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. We're going to check oil and gold for you right now. The pricing action on the back of comments from Israeli officials reiterating that they will, at some point at least, respond, of course, to that unprecedented attack by Iran over the weekend. Gold moving higher then. The risk haven moves into gold. The yellow metal continue up 0.2% so far in the session, trading at 2,387 per troy ounce. And the move in oil, it was less pronounced this time yesterday, but you have seen the moves higher again on the back of some of this commentary out of Israel. Currently above $90 a barrel on Brent, up 0.6%. And then, of course, when it comes to WTI, also moving higher, up about 0.7%, close to $86 a barrel. Let's get more then on how the geopolitics is unfolding. The US House set to vote separately on new aid to Israel and Ukraine this week following Iran's missile and drone attack over the weekend. Meanwhile, top Israeli military officials, as I mentioned, reasserting that their country has no choice but to respond to Iran's weekend attack. Let's bring in Bloomberg's EMEA News Director now, Ros Mattison, for the latest. Ros, is the risk then at this point of an Israeli strike against Iran on Iranian territory, is that risk rising? What might that look like?
Well, certainly it is rising. As you said, what we've got is the US and European countries urging restraint on the part of Israel. They're saying don't antagonize Iran further. What you need to do is to isolate Iran here. But with the commentary from Israeli officials to the very top is very clear. They feel that they have to retaliate in some fashion against Iran for this weekend attack, which was the first direct attack from Iranian soil on Israel. And they say that they have to respond in some fashion. What that looks like is very unclear. When it happens is very unclear. There's a wide range of possibilities here, from a direct attack, as you say, from Israel on Iran. That would not be unprecedented, but that's one option for them, targeting military sites, perhaps even nuclear sites in Iran. Of course, there's a lot of concern about Iran's nuclear program. Or does it go for something instead, like going for one of Iran's proxies in the region? We're talking about the Houthis in Yemen. We're talking about Hamas in Gaza, Hezbollah in Lebanon. Do they go through one of those proxies to retaliate? Do they do something potentially even in the cyberspace? There's a lot of options here, from fairly small ball responses really to something that would risk potentially setting off a further tit for tat with Iran. And that really is the concern you see from the US, Europe and others, is that do you get into this era where we're basically back and forth constantly with strikes between Israel and Iran?
And as you say, that's exactly what the US does not want to see. So where does that leave the position of the Biden presidency and those in Washington, D.C.?
Well, it leaves them in a really awkward position because, of course, the US is a key ally of Israel militarily, economically, strategically, you name it. And they've said they're steadfast in their support for Israel, especially, you know, in terms of responding to Hamas in Gaza, in support against Iran. But, you know, it can only go so far. There's a deep, deep sense of unease that's going on in the US about the possibility of that wider conflict. So they're caught between their need to support Israel on the one hand and also their concern about a wider conflict, because if that does happen, not only do you potentially hit things like oil, you know, you hit supply of some key commodities, but you risk pulling the US in increasingly militarily to that conflict. And that's something that no one in the US wants coming up to an election. So they're in a really awkward position where they're urging Israel to be restrained, but Israel is saying, well, we're going to do what we need to do in this minute.
How is all of this playing into the debate domestically, at least politically in the US, around support for both Israel and Ukraine? We're hearing of reports that the House may move on something by the end of this week. How likely is that at this point?
Well, it does sound there's now momentum to push towards those separate bills. Basically, what the Speaker is trying to do is separate out the aid for Ukraine and the aid for Israel, because there's possibly more support for supporting Israel in this moment, sending fresh aid there. Of course, the US has said they won't stop sending Israel weapons or supplying them militarily in this minute. Of course, the aid for Ukraine is a lot more fraught. It's been bogged down for months now in Congress, and there's a real sense of fatigue in the part of the US about continuing to supply Ukraine with that aid. And so what they're trying to do now is separate those out. It does seem as though politically there's more support for Israel in this minute, and especially allowing them to be able to defend themselves against Iran. So that will probably get through easier, I would say, than the aid for Ukraine.
OK, Bloomberg's Ros Matheson with an excellent update for us in terms of how events are unfolding in the Middle East and the US response as well. Ros, thank you very much indeed. Coming up, we're going to switch focus because over in parts of Africa, a severe drought gripping at least parts of southern Africa. Zimbabwe considering importing corn from Brazil for the first time in 10 years. We bring you the details of that story next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Let's turn our focus now to the severe drought in parts of southern Africa. Zimbabwe is considering importing corn from Brazil for the first time since 2014. That's as the El Nino weather pattern withers crops in the country. Malawi and Zambia have also declared a state of national disaster. Let's bring in Bloomberg's Ondiro Ganga then for the details, who's joining us out of Kigali for the latest. Ondiro, corn then, a staple food, of course, across many of these nations. What impact is being felt?
Tom, at the center of natural disasters like this are people, and SADC is estimating that 20 million people are in dire need of humanitarian assistance. They also say that the rainfall patterns between January and March are the worst in 40 years. If we zoom in on Zimbabwe, February was their driest month, and nearly 80% of the country did not get adequate rainfall. And this means that agricultural production was hampered. Corn supply or corn production was reduced by 20% in South Africa and 80%, or rather 60% in Zimbabwe. And their president took to a national televised address to tell them that it will take at least $2 billion to combat the impact of this drought that they're facing. You look at Zambia, inflation is also high, 15.6%, mainly driven by the prices of cereals, bread and meat. So what this just means is that these three countries that have declared a state of national emergency, Zambia, Zimbabwe, Malawi, otherwise are self-sufficient countries, and this speaks to the unchecked effects of climate change.
So what are the options then that millers are considering to offset this challenge?
They will be heading to Sao Paulo, Brazil, to try and get 300,000 tons of grain. But this is just a drop in the ocean because the country consumes about 2.2 million tons. The good news is that because of the drought, all the way from Q4 of 2024 to Q1 of 2025, production will be hampered. So this will go a long way in covering supply. But then again, it will have an impact on inflation because of the prices of importing.
OK, so the inflationary impacts in focus as well, as maybe Brazil can offset some of the pressure across Zimbabwe and other nations. Ondiro Ganga with the latest there on an important story that's developing across southern Africa. Thank you. Coming up, another big week for US bank earnings with Goldman Sachs closing higher by about 6% after posting a profit jump. Bank of America, Morgan Stanley are still to come. We look ahead at those bank earnings next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. A surging dollar bulldozes through Asian FX. The region stocks also take a big hit following a big tech sell-off on Wall Street. The Fed's Mary Daly says there is no rush to start cutting rates. China's first quarter GDP growth beats expectations, but retail sales and industrial output disappoint in March, suggesting a slowdown is already underway. Plus, Israeli military officials say they have no choice but to respond to Iran's missile and drone attack. This as the US House prepares to vote on new aid to Israel and Ukraine. Let's check these markets then on a Dow a day. It seems in terms of the futures pointing lower across Europe and the US. The down day, of course, across US stocks yesterday pronounced with big tech, as we said in the headlines, selling off. The S&P closing lower by 1.2%, back below that 5,100 level on stronger US data, reinforcing those higher for longer rate expectations. Of course, the geopolitical overlay continues to be there as well. European futures pointing lower by a full 1%, a little over 1%, in fact, looking at a drop of 55 points so far. FTSE 100 is looking lower by a 1% as well, looking to drop around 80 points so far in the session. The FTSE 100 pointing to 7,899. S&P futures pointing lower by about 0.1%. NASDAQ futures currently flat, so reversing some of the earlier downside, but still pointing to further losses to build on the picture of yesterday. Let's flip the board cross-asset. We also saw a sell-off across US Treasuries, with the 2-year getting close to 5%. The 10-year yields up 9 basis points in the session yesterday. 4.6 currently on the US benchmark right now. We talked about dollar strength in the headlines. We're going to unpack that story for you as well. The pound in focus, 124. A little bit of pressure coming through, marginally lightly down to what's happening with stronger dollar. Down 0.1% on the pound, but we will look for that data as well on wages and jobs, 7 a.m. UK time, and then inflation data out of the UK on Wednesday. Brent above $90 a barrel, closing in 91, up 0.7%. Iron ore, $110 currently, and down 1.2%, and arguably you can tie that to the mixed data out of China. Let's talk the FX story then and bring in Mark Cranfield right now from Bloomberg MLive, a strategist there. Mark, talk to us about the dollar strength that's coming through. Is this a risk haven move into the dollar, or is this on the back of stronger data and expectations that rates are not going to be cut anytime soon, or is it a combination of the both?
Yeah, all of the above. It was the dollar was already strong coming into Asia this morning, as you say. We've had pushback from Federal Reserve speakers. It looks as though it's going to take longer for them to lower interest rates. Retail sales was the latest in a series of strong data prints from the United States. So we came in this morning with dollar yen especially very, very strong, above 154. That just lifted dollar Asian markets across the board, and then China's fixing came in and they allowed the yuan to weaken as well, and that was just the icing on the cake. So off the back of that, we've seen Indonesian rupiah, the Indian rupee, Thai baht, Korean won. They've all just been tumbling one after the other, and Australian dollar, Kiwi as well, all coming down as well. So it's just really been across the board. That also has fed into the equity markets as well. They're already pretty nervous anyway after a rough night for Wall Street last night. So we've got a sea of red across Asian equities, and it's just one thing feeding into another. Of course, we've got a Bank of Japan meeting next week, which is now becoming a lot more interesting than maybe it was just a few days ago, because Governor Ueda from the Bank of Japan has said that the yen feeds into inflationary expectations in Japan. That is not something that was said by previous BOJ governors. So clearly the yen is on his radar. The Ministry of Finance have been pretty quiet today, haven't said too much about it. Maybe there's some kind of pact coming up between the two of them. Whichever way it is, for now, traders are not being put off. Some people are even talking about 160 in dollar yen. But that's one thing's for sure. Foreign exchange markets are alive and kicking, and that's where the action is today.
Yeah, they certainly are, indeed. And on the story of the yen then, is it the expectation, you touched on this, the view that maybe you get to 160, some even saying 170. Is the view then simply that intervention will not work at this point?
Well, they have a bit of a problem here. I mean, it's not to say that intervention wouldn't work, but it's how far would it go? Because the big difference, October 2022 was the last time that the Japanese successfully intervened to strengthen the yen. What they had in their favour at that time, they caught the market a bit by surprise, but probably more importantly, US yields were coming down at the same time. So you had a negative impact from the US side and you had the Japanese side improving as well. So put the two together, it helped dollar yen to come down quite a long way. This time around, if the Japanese authorities do decide to support the yen, they're completely on their own, because we've seen in recent days that the Fed is pushing further and further away in terms of lowering interest rates. So there's no help from the US side at all. And certainly the idea of coordinated intervention is certainly not on the table at all. So if the Japanese go ahead, they'll have to intervene very large. They may get some strength out of the yen, but probably not as much as they got 2 years ago.
Okay, 154 on US dollar yen right now. Mark Cranfield with a brilliant deep dive on what is rippling across these FX markets this morning. MLI's Mark Cranfield, of course, with the analysis. Thank you. Now to the bank earnings story, and the season, of course, in terms of the earnings picture continues with Bank of America, Morgan Stanley due to report later. This after, of course, Goldman Sachs shares closed higher after the lender posted a surprise profit jump in the first quarter.
Very good about our first quarter results, which reflect the strength of our world-class and interconnected franchises and the earnings power of our firm. This performance was aided by the swift actions we took last year to narrow our strategic focus and play to our core strengths.
OK, let's bring in Bloomberg's Charlie Wells then for the analysis. Charlie, how did Goldman Sachs manage to come through with such a solid beat? What were the drivers for Goldman?
Yeah, so look, their driver here really was a return to basics. And so we heard David Solomon there talk about how they made swift action, how they really made this turnaround from really trying to push into retail banking. And last year really was an execution year for the bank. And we saw them just go back into core. And when you look at these core units, it's hard not to find an area where they beat. So in fixed income trading, they beat. Revenue there was $4 billion. Equities trading, $3 billion. Investment banking fees, a beat as well of $2 billion coming in. We've got M&A fees, $1 billion. And then their wealth management unit, which is what these banks really want. It brings in those stable fees kind of almost in any environment. They beat as well, bringing in revenue of $4 billion almost.
So we've got Morgan Stanley, Bank of America reporting later. Morgan Stanley also obviously a very close rival for Goldman Sachs. And I just wonder if they can replicate the kind of results. What are you and the team going to be scrutinising from those two lenders?
Yeah, so a little bit more difficult of a news cycle for Morgan Stanley. And so they've been talking about some pressure in their wealth management unit. Ted Pick, who just took over in January, he's called wealth management the engine of Morgan Stanley. But it's been under a little bit of pressure with inflows, some profit margin pressure. So that will be really interesting to watch today. As far as Bank of America, the expectation is that it looks a little bit similar to, say, Wells Fargo or JP Morgan, who reported slightly disappointing earnings last week, in particular on net interest income. So that's coming under pressure as consumers seek to get more in their deposits, as there's more competition in that deposit space for where they put their money, and potentially Bank of America having to pay more to keep those deposits than they get from lending out money.
Well, coming to the last leg then of the earnings season when it comes to US banks, what are kind of the big takeaways for you?
Yeah, Tom, I would say that, the message we're getting from some of these banks is kind of a return to the old normal. So that old normal where, net interest income wasn't getting this huge boost that it was getting from rates, a return to the old normal at the likes of Goldman Sachs, where they're really focusing more on core, and a return to maybe the very old normal for consumers, where, say, thinking about maybe the 1990s, when consumers were very used to, competition for where they were going to put their deposits, for competition over rates, that sort of a return to an old normal, which we could potentially see as we hear, inklings that the Federal Reserve may not be cutting rates as much as markets had priced in earlier this year.
Charlie Wells, thank you very much indeed. Breaking down the Goldman Sachs beat that came through yesterday and looking ahead, of course, to Bank of America and Morgan Stanley. What to watch for later today. Touched on the Fed, of course. New York Fed President, meanwhile, John Williams, believing that the US central bank will likely start cutting rates later this year if inflation continues to gradually ease. He also discussed resilience in consumer spending in the exclusive conversation with Bloomberg TV.
Consumer spending has been strong. I think it is driven by strong fundamentals. Job growth has been solid. We've seen real wage gains. We're in a pretty strong economy with good growth. So, yes, it's part of that story. But, I think what we're realizing is we're getting a nice tailwind from the supply side of the economy. Good labor force growth, strong productivity, good real wage gains. So with that, I think, consumers are spending.
What's the thinking in your office and among your colleagues about, does this last? Or is this a surprise that you think could go away at any minute?
Well, one thing that makes it really hard to forecast is we're still feeling the effects of the after effects of the pandemic and Russia's war in Ukraine and all the things that have happened in between. So we're definitely still seeing an adjustment process by the consumer, in the economy overall. But overall, I think that the economy will continue to grow at a solid rate this year. Probably not as high as the 3.1% we saw last year, but something like 2% or around that. So I feel like we're still in a good place. Probably not as rapid a growth as we saw last year.
You do have the strong growth. You have very low unemployment. Why cut rates if the economy is doing fine at this level?
Well, first of all, I think monetary policy is working at the rates that we have now. So I think monetary policy is in a good place. Over the past 12 to 18 months, we've seen pretty much all the measures of imbalances in the labor market and our economy recede, many of them back to levels we saw in 2018 or 2019. So we're seeing restoring balance in the economy. We are seeing a slow decline in inflation. So I do think monetary policy right now is in a good place. I'm not fixated on where do rates need to go, over the next year. What I'm focused on is how do we best achieve our maximum employment and price stability goals. The data we're seeing show that the economy is strong, and that's really good news, and labor market strong. At the same time, we are getting better balance, and we're seeing some decline overall in inflation. So for me, it's really about getting that right, and then whatever we need to do to adjust monetary policy, we can do to best continue the progress towards our goals. So that's how I'm thinking about it, and we'll just have to keep watching the data and make the decisions based on those goals.
Well, is your base case that you will cut rates this year?
My own view is I think that with inflation continuing to gradually come down, and I guess I would say gradually is the operative word here, and with the economy remaining strong, I do think that given where the level of rates are, real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. And my own view is that that process will likely start this year. But again, it's going to be driven by the data and achieving our goals.
OK, New York Fed President John Williams speaking to Bloomberg exclusively. Coming up, our next guest says fintech is back on top as the UK's most funded startup sector. We discuss the future of the industry with Erin Platts, CEO of HSBC Innovation Banking UK. That is next. This is Bloomberg. Welcome back. Now, fintech is back on top as the UK's most funded startup sector, according to analysis from HSBC Innovation Banking and M&A database Deal Room. $1.4 billion was raised across 73 rounds in the first quarter. For the details, Len, let's bring in Erin Platts, CEO of HSBC Innovation Banking UK. We love speaking to you, Erin, because you really have a finger on the pulse in terms of the flows into UK tech. So talk to us about what you've been seeing kind of on a granular basis over the first quarter.
Sure. So Q1 actually pretty, I would say, stable, strong start. So $3.9 billion has been invested into UK tech. And that recalibrates us really kind of back to 2020 pre-COVID run rate. And that still leaves us firmly as number one in terms of the European ecosystem. 3.9 is actually almost more than France and Germany combined in Q1. And of course, firmly third globally as an innovation ecosystem.
And fintech standing out again. What is the appeal of fintech? What is drawing the funds into that particular segment of UK tech?
Yeah, so 2023 was very much the year of sort of Gen AI and climate tech. And so it is nice to see fintech back on top. London and the UK very much is a hub of financial services, various types of asset managers, insurance companies. So that talent, but also the procurement and investment into fintech just creates a lot of amazing companies, founders spinning out. And that's what's attracting both domestic and international capital into fintech.
And so coming back to some of our natural strengths, arguably, and you talk about Gen AI and some concern, some hand-wringing by the end of last year that it was looking a little frothy in terms of the fund flows. What are you seeing? Is it become? Was there a frothiness to it? Is it becoming a little bit more rational? Are those fund flows continuing? How is the picture for the UK when it comes to AI, Gen AI looking?
Yeah, so, for frontier tech, or deep tech, let's call it, which includes Gen AI, semiconductors, quantum, is still seeing a strong amount of investment. We're still seeing, pretty, let's say, substantial valuations. But this is a paradigm shift for our industry. So I think that we'll continue to see a lot of money going into Gen AI. I think the UK is really well placed in terms of talent. It's great to see Microsoft announcing a hub in London with respect to some of their development. So I would continue to expect Gen AI to outperform in terms of attracting capital. Whether it's how frothy is it, what time will tell, I suppose.
And what is the global nature then of the fund flows into the UK?
Yeah, so this actually was a surprising part of the report for me. So we've always attracted huge amounts of international capital, and that's really important to have that mix of international and domestic capital. But I looked at the data over the last 15 years, and what we ended up finding is the proportion of domestic capital going into the UK is quietly decreasing. Q1 actually had almost 40% of the money going into UK startups and scale-ups came from the US, which is the highest we've seen, again, in terms of the data that I've been tracking for 15 years. So for me, it's something to keep an eye on. We really want that US experienced capital and international capital in the UK, but we also want to see the domestic funds thrive.
Okay, and in terms of the various stages of funding, and you break this down as well, early stage versus late stage, you talk about AI. I was interviewing Noel Hurley, the CEO of a company called Literal Labs, yesterday, a spin-off from Newcastle, focused on AI. I just want to take a listen to what he had to say in terms of late stage funding and the challenges here in the UK.
One of the biggest challenges in the UK is we have all of this fantastic talent here, and yet we don't have a Microsoft, we don't have a Google. And why is that? In most cases, it's almost institutionalized now that startups in the UK end up opening a presence in the US and moving there for that scaling capital. I think that's one of the challenges. And if the government's going to address anything, it needs to address that gap.
Is that a valid concern, talking about the fact that it's almost default that UK startups will go for that later stage funding to the US? And if it is valid, what are some of the prescriptions that the government and others might look to?
Yeah, I think on this, I think Noel's right, but I think we should break it down to access to public capital and access to private capital. We've seen a huge amount of growth in terms of that growth capital from a private markets perspective be available in the UK. Now, the source of that capital is very much international, but I do think Noel's right, and the data does support most companies in the innovation space will look to the US to list. There's a few things, I think, structurally that we need to continue to work on as an ecosystem. The conversations around the Mansion House reform, that's unlocking pension capital to be deployed into both public and private markets, will very much help. I think this is a point in time. I mean, I've been in this ecosystem for 17 years, and the size and scale back 17 years ago versus where we are here is night and day. So I'm pretty optimistic that we will have, over time, a really robust public market for innovation companies. I'm not sure that that's going to really change in 2024.
Right, yeah, it seems like a longer term issue, and clearly the government has got this in its sights, but whether or not enough is being done and quickly enough is another question. You talk to us about the fund flows in the first quarter then. As you and the team look ahead to the second quarter and beyond this year, what is the focus on?
So I believe that the UK ecosystem should be about a $20 billion market in terms of per annum. There's enough amazing companies. Even we heard from Noel, there's great founders, great technology. Early stage has been robust. Now, we'll need to see a bit of an unlock in the second half of the year to hit that run rate. I'm still optimistic. But things around, interest rate reductions, if that happens, is helpful. Again, we've talked about money. This venture money is time-bound. And the anecdotal activity that we're hearing from our VC and PE partners is there's a lot of velocity with respect to term sheets. So we'll see if that converts into investment, but there's definitely enough quality to go after.
Really interesting. Always smart on the tech space, bringing us the analysis. Erin Platts, thank you very much. Indeed, the CEO, of course, of HSBC Innovation Banking UK. Now, for some of the other stories making the news, and with an eye still on the tech space, the chief of Google's AI business says the company will eventually spend more than $100 billion developing AI technology. Another sign of the investing arms race that's gripping Silicon Valley. That was Demis Hassabis, of course. Meanwhile, Donald Trump's first criminal trial got off to a slow start, with the proceedings stalling over disagreements about evidence and other last-minute arguments. Jury selection didn't kick off until the final hours of the day, as the former president's lawyers argued with prosecutors over which evidence will be admissible. More than half of the first panel of 96 potential jurors had to be excused after saying they could not be impartial. Plenty more coming up. We're going to preview some of the data out of the UK. It drops at 7 a.m. What it means, of course, for the BOE. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Tuesday. We have some data dropping 7 a.m. UK time, so in a little over 5 minutes' time, on wages and, of course, the jobs picture here in the UK. That's ahead of inflation that drops on Wednesday. So rounding out the picture in terms of what we can think about when it comes to the BOE's next steps, we know that the services component of CPI in the UK has been relatively sticky. A lot of that is down to the wages story. There is an expectation that wage data today is going to come in a little softer, but you can see the white line is the weekly earnings 3 month by 3 month. That's the white line. You can see that just a little below 6 right now. Services CPI remaining elevated then in terms of being above 6. So it's the wages continuing to keep the services part higher. You need to see arguably a breakdown in the wages within services to see that component come lower and the BOE to take a little bit more comfort. Let's flip the board and have a look at what it means when it comes to the jobs picture. And frankly, it's a bit confusing given, of course, that we are working through a new statistical format and the surveys have been challenged. The labour force surveys that have been coming through. And there's this gap, as you can see, in terms of the blue line and the white line between the labour force survey unemployment rate and the experimental data, and a gap of between 4.2% in terms of the unemployment or 3.9%. Where are we in reality remains a bit of a question. So in terms of the unemployment data, it remains still a little bit confusing here in the UK as they try and work through some of those changes. What this all means, of course, for the BOE, and as I said, the CPI, so the inflation print that comes through on Wednesday, is going to be really important, of course, to that as well. Let's flip the board and have a look in terms of how we've adjusted around the BOE. Expectations of just 2 cuts of 25 basis points each, that's the green line, compared to just a little over 1 for the Fed, but still on 3 for the ECB. So that's how the 3 major central banks here, of course, are lining up. The BOE in the middle, still expectations of 2. The data today will help inform whether or not that is reality or realistic, I should say. A reminder, we're going to be speaking, of course, to the UK's Chancellor of the Exchequer, Jeremy Hunt, on the outlook for the British economy. Joining us at 7:10 p.m. UK time for that. Up next, though, markets today with Kriti Gupta and Guy Johnson. This is Bloomberg.